for a put option at that price. Right there. 264.35. He actually paid 264.35 on that trade, right? So where's the dealer hedge? So in other words, this is a bullish call, isn't it? This is a bullish trade. So this is a $1.2 million bullish trade right here for whatever reason and whatever structure's in place. When you see that happening, you start saying, wait a second, that's buy side trade. And sure enough, SQ has just went from 264 to 265. 264 to 265. I know it doesn't sound like much, guys, but you know, when you're trading as a day trade stock trader, that's a good little scalp profit, guys. I mean, imagine that was your S&P chart or your Dow Jones chart or your oil chart, that little break there. Just because it's stocks doesn't mean it's got to go for 1,000% every time you dig a deal. You know, this is still a good little scalp trade. Nice, quick profit, boom, stops at break even, move on to the next option. Now, I don't like in the money calls because, or in the money puts, I don't like those types of trades because all you're seeing is a block trade. All you're seeing is somebody that's doing a block trade without doing a block trade. But, you know, they're still of interest to me as a scalper. There's still something that I can look at and say, let's do some business on this and see if we can pick up a quick scalp for a couple of percentage points. And that's what we look for when we're looking at these types of trades, guys. Let's catch up with oil. It's a funny one. Supply coming in. The bond market says lower prices. The euro dollar stopping it going lower just now, so we're getting a little bid at the bottom edges because of that little rally in the euro dollar. So if we get any weakness on that euro dollar, that's going to send that oil price spiraling off that top edge at that stage. It's going to send that oil price spiraling off the top edge, and we should obviously see a bit of a sell side action, maybe pouring back into the black stuff for that sell off through that phase. Now, you can already recognize the structure to this trade. It's got a very, very obvious capping price. It's got a very obvious top edge. So we can already recognize the structure to this. We've got a target price now in mind of 58.20s for that oil short trade at 58.70. So that gives us a $500 trade, which is quite nice. Now, the one thing we've got to remember, of course, is the concept that we had in classroom from the other day. Oil's been an amazing market for this concept in the last short while. For a very simple reason. I'll show you this. Now, this is one of those complicated things that a lot of people forget about. This is today's oil calendars. Remember this oil calendar, this is today's oil calendars. So to get an idea about today's oil calendars, we really need to see yesterday's oil calendars, okay? So we want to know where yesterday's highs and yesterday's lows were, because these are going to be key levels for us as traders, right? So yesterday's highs and yesterday's lows, we've already now recognized. The low in the oil calendars is right here, correct? That's an overnight session low, actually. The low of the US session was just in here. So we now have two low prices that we can obviously pay very close attention to on the calendar itself. In terms of high prices, of course, we can see that yesterday's high price kind of pins at the very, very, very high price up here. But you can see that there's been real genuine selling coming back in at this price as well. In the day trade now, in the day trade world of the London session, of course, you can see that the high price is actually a lot lower in this area here. So now we've got some key levels that people may, bearing in mind the calendar spread is a stochastic type trade. It's a trade that we have. If you understand what I mean by stochastic type trade, in the background you'll understand this process, because you'll see that this type of trade does go backwards and forwards a lot. So there's a lot of bids and offers at highs and lows on the calendars, right? So what does that mean? Well, that means we should be very mindful of the fact that when oil trades at this price level, there's going to be a good chance there's going to be a sell trade. When oil trades at this level, a buy trade at this level, a buy trade at this level, a buy trade. And when we go through the top edges, and when we start seeing new top edges forming at this level, a sell trade. So we know that this could start impacting on our oil prices. So now we've got the levels on our charts, we can start looking to see how those levels actually interact, right? So we can start looking at the fact that we'd already called this as a possible top edge just in here. We'd already called that as a possible top edge right there. Well, guess what? The oil price then did sell off of that possible top edge, right? We already knew that this would be a possible bottom edge. Within one candle, the price rallied. We already knew that this would be a possible bottom edge here. The price rallied immediately. We all knew that this could have been a possible bottom edge here. The price rallied immediately. So when we know these things, when we see this could be a possible top edge, as it breaks through these areas, what happened to oil? The price rolled over and sold off. Amazing, right? So in other words, we don't necessarily need to see divergence in the calendars. It's obviously better if we see divergence in the calendars, but we don't necessarily need to see it. What we do need to see is, because if we try and trade these as buy-side, sell-side levels on its own, the calendars as buy-side, sell-side levels, this is going to give us a possible lead-in to an oil trade before it even shows up. Now, obviously, if we can add to that big surge in volumes, if we can add to that a big block trade, if we can add to that a big build in the book order flow, then obviously we can start leaning against these key levels a lot more aggressively. So obviously when we start seeing the calendar spread going back up but oil slowing down, and then we see this big drop here, we're saying this has got to sell off. This has to sell off. Calendar spreads are very expensive. If the calendar spreads are very expensive, then people are likely to roll out of oil long positions into short positions. Sure enough, they've rolled into short positions and we've had a beautiful break to the downside. We've covered this the other day, guys. This is not obviously anything new. And if you can just add to your idea and understanding of these things, you would see these ideas developing in the background, yeah? That just checking in on how Square's doing, you can see that Square's actually done okay. The prices came back to that bullish macro level. And you can see it's bought back away from it again. We did tell you it was a buy level, and sure enough, there it is. I mean, again, it's not a big trade, but again, it's went from $264, trading $265, another dollar profit on a $200 stock. Well, that's not a lot of money, but it's not a loss. It's a stop at break even, worst case scenario, again on another stock pick, guys, another stop at break even, using the options markets to read the outcomes from these. You can see how high probability these trades become, yeah? Incredible stuff, right? He says, waiting for a wild, rapturous response. Yeah, damn, tootin' right, it's incredible. Yeah, it's only a fraction of 1% rate. Get a grip, do you know what I mean? Fraction of 1%.